India's 2026 strategic pivot navigating the new global trade order. As India enters the second week of March 2026, the nation economic and geopolitical landscape is undergoing a profound transformation. The central theme of this period is a strategic realignment, a high-stake pivot where New Delhi is trading its historical energy neutrality for a preferred seat in the American-led industrial order. This shift crystallized by the implementation of the Interim Trade Framework with the United States represents the most significant recalibration of Indian foreign policy in decades. The tariff breakthrough and manufacturing survival, the core of the analysis lies in the dramatic reduction of US tariff on Indian goods. Following intense negotiation, Washington has slashed effective tariffs on made in India products from a punitive 25% down to a standardized 18%. For India's massive textile, apparel, and footwear sector, which employ millions and operate on razor thin margins, like 7% relief is not merely a policy change, it is a lifeline. By securing this rate, India has effectively underpriced regional competitors like Vietnam and Bangladesh, who currently faces US duties exceeding 20%. This most favored status signaled that the Trump administration now views India as its primary strategic economic counterweight to China in the Indo-Pacific. Consequently, global China Plus One investment flows, which had slowed in 2025, are now surging towards India's new industrial corridors in Tamil Nadu and Gujarat. Trading oil for access, the price for this manufacturing access was a historic energy concession. India has officially committed to phased but total halt of Russian oil imports, pivoting its massive requirement toward the United States and Venezuela. This $500 billion multi-year commitment includes unprecedented purchases of American crude and liquefied natural gas. While critics initially feared this would trigger domestic fuel inflation, the trade deal's broader benefits have stabilized the rupee, offsetting higher landing costs. Furthermore, the agreement grants US firm significant access to India's burgeoning civil nuclear and green hydrogen markets. This energy for exports swap is the cornerstone of India's 2026 strategy, ensuring that the country's industrial engine remains fueled while securing a green certificates of its exports to Western market. Complementing this external shift is the 53.5 lakh crore Union Budget 2026, which has funneled a record of 12.2 lakh crore into capital expenditure. The government is building a physical pipe for the trade deal success. The launch of 5 new industrial growth connectors, including the Bangalore-Hyderabad high-speed freight corridor, aims to reduce India's logistics cost from 13% of GDP to a global standard of 8% by 2028. However, the analysis is not without risk. The ongoing aviation meltdown, the regional tension in the Middle East have disrupted air freight routes, threatening the timely delivery of high-value Indian electronics and pharmaceuticals. Additionally, the strategic reset with Canada, highlighted by Prime Minister Mark Carney, recent Mumbai's visits show that New Delhi is still hedging its bets, seeking a 10-year uranium deal with Ottawa to ensure energy security isn't solely dependent on US politics.